Apple stock is on fire this year. It hit a low of 123 on January 3rd. It's now at 177. Warren Buffett owns the stock, but I believe he's buying it at sub 140. So the question is, should you be buying Apple stock right now? It is up year to date 42.38%. So it's hard to sit there and avoid the excitement of Apple stocks. The question is, what is a good price to pay for Apple? So if you're new to the channel, I'm Paul, that's Mo. We are investors. We believe two fundamental things. One, when you buy a stock, you're buying a piece of a business. And two, every investment's the present value of all future cash flow. We are here to teach a process. Our process is driven on those two major points. If those speak to you, you're in the right place.
All right, Paul. Well, there's two major news stories of why this stock has been flossing the past couple of days, weeks. They just announced some partnership with Broadcom for their 5G. So they're going to be enhancing their phones, enhancing the 5G. This has been something, I think it was announced sometime last week. It is just soaring. And the second one is their new savings accounts. So you put money into their Apple Cash, you get some type 4.15% APR or something like that. In 4 days, they drew nearly $1 billion.
Yeah, it's pretty impressive.
Yeah, so people are going into that. I mean, 4.15% is nothing to write home.
Well, I think a big part of the news also is the fact that Warren Buffett has been buying a lot of Apple. Yeah. Of course, it's funny to us that when Warren Buffett does something that benefits our investments, we go, see, look. And then when he does it, it's like, oh, he's an old dinosaur.
He actually said in his annual meeting, he said it's the best business that they own, better than any business that they own.
I think he said it's the best business he's ever seen in his lifetime.
Yeah, it's amazing.
So guys, just like everything, no company is perfect, and usually in bad situations, no company is the worst. So there are bull and bear cases for everything. So Mo, give us the bull and bear cases for Apple right now.
So a couple of bull cases. Global active iPhone users grew 11% over the last 12 months from 1.57 to 1.74 billion users. Pretty big.
Wow.
Pretty big jump. Apple's high margin service segment, which is 70% gross margin, has increased a percentage of revenue from 15 to 22%.
That's a lot of data.
It's a lot of data. Now, going on to the bear side, because there are bear cases against Apple. For the 3 months ending March 26, 2022, iMac and iPad sales have fallen 31 and 12% respectively.
I'm actually surprised about the iPad one.
Me too.
Wow.
Me too. iMac and iPad makes up 15% of their revenue. So it's a big fall. But again, I mean, I go back to COVID. People were buying iPads and staying home and school and Zoom and everything. Maybe it's just coming back based on that.
Okay, maybe so.
So there you go.
All right, guys. So let's go over some basics about the company. Now, it's really important. I'm going to explain metrics as we go along. It's not important that you grasp them immediately right now. Subscribe to the channel. When you watch our videos, it'll start to click more and more. We have our community of thousands of people, and they now get it. But same with me, it took some time. So first off, market cap of $2.8 trillion. This means we bought every share on the market. Everyone out there at market price, you'd pay $2.8 trillion. What do you compare it to? Right here, enterprise value. Enterprise value is essentially buying all the shares, plus paying for all the debt, and then deducting the cash on the books, right? Because if you take over debt from something, that's part of your investment in the company. This difference right here is essentially the net debt. This is a very close number here, very small. An example of something be bad, Paramount Global has a $10 billion market cap and a $43 billion enterprise value. A lot more debt there than equity. So just remember that going forward. A couple other things. PE, their 1-year PE is 30, their 5-year PE is 36. All right. Very simply, PE is price to earnings, very common metric. You take the market cap divided by the last 12 months of net income. Boom. That's how you get your PE. Okay. Profit margin, very consistent, just net income divided by revenue. And they're very consistent here, which we like to see for a big company. Okay. Small dividend yield of 0.5%. This is dividends paid divided by the market cap. Now, here's what we do with dividends. We want to make sure that the dividends are easily handled by the free cash flow. That's why on our software, we put the free cash flow right above dividends. Last year, they did $97 billion in free cash flow. What is free cash flow? It is cash from operations less your capital expenditures. You can do 5 things with that money. Buy back shares, pay down debt, pay a dividend, reinvest back in yourself, and make acquisitions, okay? So they're taking $15 billion of their $97 billion last year and paying out dividends. Our goal is to buy companies where the dividends are less than half of the 5-year average free cash flow. So in this situation, it's way less than half. It's less than 20% of their 5-year free cash flow. So something tells me that this is a very, very stable dividend. In fact, my guess is they'll probably start increasing their dividend over time as they see less and less opportunity for reinvestment.
Yeah.
Okay.
The lowest free cash flow they've done in the past decade was $46 billion. So even if they went back to that, still safe.
And that's what we can do, guys. We can actually go to this cash flow statement here, and we actually put in our software here the free cash flow by year. We do the math for you. Other financial statements don't have this, but look at this. Free cash flow growth is incredible there. All right, final metric I want to go over, return on invested capital. This is what Warren Buffett loves about this company, 39%. The market average is 9 to 10%. What this means is they get an incredible return on the money invested in the business through debt and equity. Because when you start a company, you can either borrow money, which is debt, or you can put money in or take investors on, which is equity. This says they get a high return on that money that's invested, which also shows a moat. This is why value investors, any investors, should love return on invested capital. The higher it is, the more likely there's a very, very strong moat. And that's what they love about it. Now, our 8-pillar process is what we really use to screen out stocks. So we have this 8-pillar tab right here. I don't make decisions just based on this. Never. But when I use an opportunity to screen things out, right, Mo?
Yep.
So like when I look at this immediately, I see a lot of check marks and 2 X's. This is a very common one. This is our valuation metrics. The 5-year PE and the 5-year price of free cash flow looks high. Now, do I know it's high? I don't know. But when I look at all these other things, like, okay, everything else is checking out. They're buying back shares. They have cash flow growth. They have low debt. They have revenue growth, high return on invested capital, and net income growth. Great. But if it's too expensive, I don't care about those other things. So here, it's basically telling me, listen, this could be expensive. But remember what we said, high return on invested capital. You should want to pay more money. So for me, when I look at these 8 pillars, I go, wait a second. Yes, this is 2 X's, but this tells me, Paul, you should pay more money for this company. So maybe this isn't so bad. That's how I use the 8 pillars. I don't use it as, oh, great, it's all 8 check marks, I'm buying it. No. You have to make sure the pillars follow the right story. I've bought companies with all 8 X's. Right? And I've ignored companies that have all 8 check marks. Yep. It's about screening it out and using this information to ask the next questions. So far, we've gone through all the things here that make the software great. We haven't even touched the stock analyzer tool or analyst estimates or any of these other tools. So guys, if you're serious about investing, $1 per day, we're running a special, $7, 7 days, everythingmoney.com. You get everything you've seen, plus our stock analyzer tool, plus this community of thousands of like-minded investors that you can talk to. Search for a stock, go right to the conversation, and engage people about that specific company. It is $1 per day. Don't be cheap. Go to everythingmoney.com, sign up now.
All right, so let's go over and see what the analysts are saying. Now, remember, guys, we're going to go see some analyst estimates looking out the next 4 or 5 years. But remember, do not go and don't take them for the gospel. There was no analyst that said that Silicon Valley Bank was going to do what it did. First Republic was going to do what it did. So take it with a grain of salt, but maybe use it as a guide when you start implementing things in the stock analyzer. So earnings growth, $6.07 the end of this year to $8.31. It's a high single-digit growth on the earnings side.
Yeah, and that makes sense for a company as big as Apple.
I mean, it's almost a $3 trillion company. From the revenue side, $396 billion at the end of this year to $520 billion at the end of 2027. So mid-single-digit growth. Now, to me, I think that the subscription side could start driving a new piece of revenue that a lot of people are not factoring in.
Yeah, in a very high margin
space too.
That's the big thing.
Exactly. So we'll implement that when we go into our stock analyzer tool, which we're going to do right now. So let's go make a 10-year assumption on this thing.
Okay, so our stock analyzer tool, it was used 1.3 million times last year by our users in the community. And the reason being is it answers the question of what's the present value of all my future cash flows? Remember I said at the beginning, if you believe that buying a stock is buying a piece of a business, and you also believe that every investment is the present value of all future cash flow. Remember think about that. It means if I told you I was going to give you $1 a year for the next 50 years, what would you pay for that today? Mm-hmm. Would you pay $100 for it? No, of course not. You're not going to pay $100 to take 50 years to get $1 back. Plus, what if I die? And what if I go under? And there's all these questions you have to ask. That's what we're doing here with the stock analyzer tool. We're making low, middle, and high assumptions on everything having to do with income and profit, and it'll spit out the end what we should pay based on those assumptions. All right.
Correct.
So let's do a 10-year analysis. Mo, give me your low, middle, and high for revenue growth. And by the way, the one thing we did add here, look at this, Mo. Growing ROIC.
I love it. I love seeing that.
This shows us exactly what we want to see, a growing moat.
Yep.
Okay, so Mo, what are revenue growth assumptions for the next 10 years for Apple?
I was thinking 4, 8, and 12. What do you think about
4,
that?
8, and 12. My personal opinion, I was going to do 3, 5, and 7, or 3, 6, and 9.
Okay. Do you want to do 3, 6, and 9?
Let's do 3, 6, and 9 because I look at it going, okay, they still have some declining revenue for the next year or so. 6% revenue growth isn't absurd.
Okay.
And 9 for a company this size.
It's big. Yeah.
Okay, profit margin.
24, 26, 28.
So you're assuming...
I'm assuming higher margins in the subscription side. That's my assumption there.
Okay, got it.
And I'm kind of...
Can I make one suggestion?
Yeah.
Let's do 23, 26, and 29.
Okay.
Because I do think we should put 23 in here because even though profit margin has been increasing, I just want to be a little more conservative and put that in there.
All right, sounds good.
Free cash flow.
Man, I'm almost tempted to just go 25 and a half across the board.
Yeah, but if what you said before...
It should increase.
It should increase.
What do you think about doing the same thing? 24, 20...
I actually think 24, 26, 28.
Okay.
All right. Now PE.
Oh, this would be a tough one.
So remember, Warren Buffett bought Coca-Cola in 1987 at a 30 PE.
Yeah.
But we know he's not buying Apple at a 30 PE.
Right.
Why is that?
Don't know. I don't know.
So this is where, guys, this is the art of investing.
Yeah.
This is where it makes it hard. What's a reasonable multiple to pay for the company? That's what you have to decide. We don't know. There's no tried and true value to pay for a company. This is what makes investing difficult.
Right.
Because one person might say 30p, another person might say no, 15. Remember, the market historical average on PE is 15 to 16. But shouldn't you pay more for this? Shouldn't you pay more for a moat? Absolutely.
What do you think about 18, 20, and 22?
How about 16, 19, and 22?
Okay.
And the reason being is, what if they just flounder?
Yeah. Okay.
I mean, I know that's big. I think I'd like to go more on the low side over here.
Okay.
But me,
I like going to the high side.
Yeah, over there.
Yeah.
So what about for price of free cash
I would
flow?
put the same thing.
Right. Now, guys, desired annual return. This is essentially your margin of safety. The higher your assumptions, the less likely they are to occur. So you need more return to take that risk. If you invest in a long-term ETF, you're going to get 9 or 10%. So you have to factor that in. My suggestion is, unless you're making absurdly low assumptions, probably be in the 9 or 10 minimum range for the low PE, for the low desired return. And as your assumptions go higher, you want a higher return. So Mo, what would you do?
I was going to say 10, 12, and 14.
Okay, I'm fine with that. And by the way, what was their revenue last year?
They did, let's see here, $385.1 billion.
So we would take their revenue on the high side to 911, never forget, $1 billion in 10 years, based on 9% revenue growth. And guess what? As the world gets more mature, as prices go up, as these things all happen, remember, there's two drivers of revenue: costs and natural growth, organic growth. And there are more people in the world becoming wealthier and wealthier and buying more and more. So we hit the analyze button. Now, before we go further, if it's all red, doesn't mean you go avoid it and don't buy it. If it's close, you can add it to your watch list here at a certain price and our software will notify you. If it's all green, it doesn't mean go out and go buy it. It still means, hey, make sure there's other attributes of the company that you like. But seeing all green is a wonderful sign for a great place to start. All right? So we hit the analyze button, boom. We have a low price of 85 to 90, a high price of 150 to 155, and a middle price of 115. Okay, I have it on my watch list at 125 because unlike Warren Buffett, I've got limited capital. So I need to make a higher return than Warren Buffett does. His goal is just to preserve capital in great companies. I bet you Warren Buffett's okay making 7, 8, 9% of this company.
Yeah.
So guys, again, everythingmoney.com, $7, 7 days, $1 per day. Try it out. Worst case, subscribe to the channel. You will learn a ton and your view of money will change because the more you learn, the less you fear.